Okay, let's unpack this.
Let's do it.
Today we're doing what really amounts to a tough journalistic investigation. We've been digging through a pile of sources, economic reports, new policy outlines, market data, and frankly, they paint two completely different pictures of the U.S. economy right now.
And that's really the mission here. The headlines, they're giving us plenty of reason to celebrate. But when you do a hard analytical breakdown of the macroeconomics of the policy shifts, you start to find these structural risks that are just far more concerning than the superficial growth figures might suggest. Our goal is to give you that shortcut to being truly informed.
To look past all the noise.
Exactly.
And the noise right now is, it's deafeningly positive. The big number, the one that anchors this whole deep dive, is that the U.S. economy surged at a 4.3% annual rate in the third quarter of 2025.
Right.
That's not just good. That is robust, surprising growth.
It definitely caught a lot of analysts off guard. The sources are attributing this big acceleration to a few key things. First, the immediate impact of those recently imposed tariffs. They seem to have bolstered domestic spending, at least for a moment. Then there's, measurable success in bringing down inflation.
Which everyone has been watching.
Everyone. And finally, an acceleration in productivity, which might be linked to some recent tech investments. If you only looked at that top-line GDP number, you'd think the recession fears from late 2024 were, completely unfounded.
But if we know one thing from doing these deep dives, it's that the top line almost never tells the whole story. The second you start digging, you find this deep-seated conflict. We're still seeing economists projecting a downturn even after this 4.3% number came out.
It really feels like a statistical mirage.
It does.
And what's fascinating here is the total contradiction in consumer behavior that the sources are showing us. We're seeing a major split.
A bifurcation.
That's the word. You have one group of consumers who feel secure, they're spending money, and they are, to use the exact phrase from the materials, coming in and lifting all the boats.
They're the ones driving this growth spike.
They are. But at the exact same time, there's another large and maybe growing segment of the population that's described as sitting in the boat, waiting for a perfect storm.
So they're holding back.
Completely. They're saving, they're cautious, they're not making major purchases. And that skepticism that suggests that a lot of this Q3 growth is just temporary. It's either from short-term policy stimulus or maybe a release of pent-up demand. It doesn't feel like genuine sustainable momentum.
The market, though, seems to have picked a side, at least for last week. We saw the S&P 500 climb 1.4%.
Right.
And what's critical here is that technology stocks were leading that charge, up 2.8%. That tells me capital's flowing right into growth and efficiency bets. Even consumer staples gained 1.8%.
The equities market is definitely optimistic, no question. It's focused on that productivity story. But the bond market, the interest rate environment, it always gives you that necessary dose of caution. We saw jobless claims tick up slightly to 303,000. And more importantly, the 30-year fixed mortgage rate is sitting at 6.35%.
That's a high number.
Yeah. It's a very high number. And that rate is a stark reminder that even if the economy is growing, the cost of capital, the price of money, it is not going down. And that cost is tied directly to the structural risk we need to talk about next.
And if we connect that cost of capital to the biggest fiscal issue we uncovered, it takes us straight to the $38 trillion elephant in the room.
The national debt.
The national debt. This feels like the core problem threatening all this supposed prosperity.
This is probably the single most important investigative insight we have for investors, for consumers, for everyone. The U.S. national debt is now over $38 trillion. And while that number is just, it's alarming on its own.
Of course.
The really critical data point is how that debt is being financed. The dynamics are changing.
What's happening specifically with the new financing?
We're seeing a measurable shift. New investors, the ones buying the latest treasury bills and notes, are now demanding significantly higher returns than in recent cycles. They want a substantial risk premium.
Wait, hold on. If U.S. Treasuries are supposed to be the safest asset on the planet, why are these very sophisticated investors suddenly demanding more? Why the higher yield?
If you drill down on that, the sources point to basically three reasons. First, there's growing anxiety about long-term fiscal sustainability. When the debt-to-GDP ratio just keeps climbing, investors start pricing in the risk of future fiscal pain.
Like higher inflation or tax hikes.
Exactly. Things that could erode the value of their payments. Second, inflation risk, even though it's down, is still a psychological factor. Investors want to be sure their returns beat any future price rises. And third, just the sheer volume of debt being issued creates a supply-demand issue. The U.S. has to pay more to attract enough buyers.
So this isn't just some abstract accounting problem. It's a direct, measurable increase in borrowing costs for the U.S. government.
Absolutely. And here's where the ripple effect hits you. The yield on U.S. Treasury debt is the global risk-free rate. It's the benchmark, the floor, for almost all other lending.
So when that floor rises,
The whole building goes up with it. When the government has to pay more interest, every other type of debt has to offer a higher return to stay attractive.
which means,
It means higher interest rates for corporations, for cities, and crucially, for you.
right,
Whether you're getting a mortgage, financing a car, or using a credit card, the cost of financing that $38 trillion debt directly impacts the cost of living for everyone.
and we're also seeing a shift in who is holding this debt.
Hmm.
I mean, China and Japan are still massive holders, but the sources say their overall shares is decreased.
It has, which implies a greater reliance on other, maybe more demanding private or sovereign wealth funds to fill that gap. It's a diversification away from the traditional steady buyers.
Interesting.
And before we move on to trade, we have to mention one specific insight on investment risk that the sources flagged. It's a good reminder that even when the macro picture is huge, these specific risks still exist.
The LNBA case.
Yes. The London Metal Exchange Brokers Association, they were at the center of a financial fraud case. $150,000 of investor money was misappropriated through a very complicated loan scheme.
Okay, so a relatively small amount in the grand scheme of things.
Right. It's tiny compared to $38 trillion, but it's a crucial footnote. It tells us that in complex global markets, there's always an inherent risk of fraud, and it demands vigilance.
That's a powerful point about transparency. Okay, let's pivot from domestic fiscal health to international friction. If the debt is the time bomb, trade warfare feels like a geopolitical accelerant. We've seen a clear move toward protectionism.
And the numbers on tariffs are dramatic.
They really are.
The sources document what you could really call a tariff shock. The average effective tariff rate jumped from around 2.5% to 6% in the new administration's first year. That's a massive policy shift that changes the price of imported goods across the board.
That is a tangible increase.
Yeah.
But is the thinking here purely economic, or is it more about national security?
Oh, it's heavily weighted toward national security, specifically when it comes to China.
Right.
The sources are laser focused on the risk created by China's dominance over critical materials.
Right.
We're not just talking about rare earths. We're talking about essential components for batteries, microchips, even crucial pharmaceutical ingredients. China controls a massive slice of the processing for these things, which creates a powerful chokehold on global supply chains.
A single point of failure. That's obviously not acceptable from a strategic view. So what are the U.S. and allies like Japan and the EU doing to counter that?
The countermove is massive, and it's expensive. It's full-scale de-risking. It involves providing just unprecedented subsidies and grants for new domestic facilities that can process these materials. On top of that, there's a ton of government funding being poured into R&D to find either alternative sources or substitute materials altogether.
It's a huge policy swing.
Yeah.
But, as we said, protectionism is a double-edged sword. While the goal is to stabilize manufacturing jobs and secure supply chains, what's the cost?
The cost is higher input prices. The tariffs might boost GDP for a quarter by reducing imports, but they simultaneously raise the cost of raw materials for U.S. industries.
So construction manufacturing.
Exactly. The cost of steel, aluminum, specialty components, it all goes up. So you might save some jobs, but you increase the cost of doing business and the final price for the consumer for almost everyone else. It's a very conscious trade-off between economic efficiency and national resilience.
Okay, let's take all these big economic forces, the 4.3% growth, the $38 trillion debt, the 6% tariff rate, and bring it all down to street level.
Yeah.
Here's where it gets really interesting. What do these policy shifts actually mean for your wallet, for the person trying to navigate all this?
The impact is everywhere, and we need to look at the cause and effect here.
Let's start with taxes and income. The sources are pretty clear about who the new tax measures are targeting, who benefits most right now.
Lower middle-income workers and anyone who relies on overtime hours. The new structure gives a pretty focused income boost to those groups. It's significant, immediate relief. But, and this is a big but, the learner has to see the timeline attached.
The expiration date.
Exactly. These tax cuts are not permanent. They're projected to expire at the end of 2026. That creates a known fiscal cliff. It means individuals and businesses have to plan for a potential tax hike in just over a year.
Moving on to consumer goods, the price picture is really a tale of two different markets. We expect some relief in a couple of major areas.
Right? Coffee and gasoline prices are expected to fall. That's mostly being attributed to, the normalization of global commodity supply chains. So that's the good news.
But the counterbalance to that is the grocery aisle. Grocery prices are already up, and it looks like that pressure is going to continue. Why that split?
It comes back to the tariffs and labor costs. Grocery inflation is being driven by the combined effects of high tariffs on agricultural inputs, things like specialized chemicals or imported equipment parts. And on top of that, rising labor costs are being built into the final price of food.
That's a perfect transition to labor. Reduced immigration has been a stated policy goal, and the sources say this is expected to really tighten the labor supply.
A tighter labor supply is a direct pressure point for businesses. It means fewer available workers, especially in those roles often filled by new immigrants. Economically, that forces companies to compete for talent, which puts upward pressure on wages, particularly for lower income and manual labor jobs. So reduced immigration could actually function as a mechanism to push those wages higher.
Finally, let's look at the auto market, which had a really surprising finding. Removing some of the electric vehicle tax credits had an immediate effect.
The shift is remarkable. The sources show that the residual value of those previously subsidized EVs dropped so much that used electric vehicles are now demonstrably cheaper than comparable gas-powered cars. It's a perfect example of how quickly a policy change can reprice an entire market.
And just a quick wrap on two other major sectors. In healthcare, the expected repeal of key Affordable Care Act subsidies is a huge legislative move on the horizon that will substantially change affordability for a lot of Americans.
And conversely, American farmers are getting a major new relief package, $1 billion. This shows a policy recognition of the financial strain in that sector, probably to offset some of those rising input costs from tariffs and volatility.
So we started this deep dive with the headline Euphoria of 4.3% GDP growth. But by applying that tough journalistic investigation, we found that number is masking much deeper, more systemic issues.
So what does this all mean for you? It means true economic understanding requires you to focus on the structural risk, not just these quarterly spikes. Yes, Q3 growth looks good on paper, maybe boosted by some temporary effects, but that growth is built on an increasingly expensive foundation.
Right. The rising cost of borrowing.
The rising cost of borrowing, the $38 trillion national debt, and major policy shifts that introduce both security and cost risks through this escalating trade warfare. These are the complexities that really define the investment landscape for the future.
The tension between the celebration of temporary growth and the reality of that crippling debt really is the defining conflict of this moment.
And that tension leads to a final provocative thought for you to explore on your own. We talked about how the world's most sophisticated investors are now demanding a significant premium to hold U.S. Treasury debt. They are factoring in increased risk where historically there was, basically none. So if the